Hello, everyone. Today, we're diving deep into a stock that has suddenly returned to the spotlight, BigBear.ai. The share price is hovering around the $7 mark, and despite the broader market being shaky, this one has surged an impressive 55% so far this year and over 140% in the last 12 months. Naturally, the biggest question traders are wrestling with is simple. Is this rally just getting started? Or are we standing on top of a cliff without knowing it? Let's break this whole story open piece by piece. BigBear.ai isn't one of those early-stage AI startups still selling dreams and prototypes. Their technology is already integrated into some of the most mission-critical environments in the U.S. government. The Department of Defense, the National Security Agency, and the United States Air Force all rely on BigBear's AI capabilities. That alone places the company in a league where very few AI players operate. However, just because a company works with powerful institutions doesn't mean everything is perfect behind the scenes. In the most recent earnings release, BigBear.ai reported that its revenue dropped by roughly 22% compared to the same period last year, and many investors overlooked how serious that decline really is. To understand what this company actually does, here's the simplest explanation. BigBear.ai specializes in analyzing huge volumes of information and turning that chaos into structured intelligence. Their software and tools help organizations detect threats, plan more efficiently, manage infrastructure, and make smarter decisions in complex environments, whether that's national borders, military operations, or large-scale logistics systems. The real advantage BigBear has over a lot of AI competitors is credibility. The tech is already being used in high-security installations. That's not marketing. That's real-world deployment at the highest level. But BigBear isn't staying confined to defense anymore. It's expanding into commercial markets where rapid data processing and predictive analytics are becoming essential. Finance, transportation systems, identity verification, and much more. The company's product lineup includes things like TrueFace, an advanced, security-focused facial recognition platform with features such as mask detection and systems that ensure someone isn't spoofing the camera with photos or recordings. They've also built tools like Veriscan, which simplifies identity verification at places like airports and shipping terminals. If these solutions gain traction in the private sector, BigBear's revenue could scale dramatically. Then there's the big strategic shift that happened recently. On December 1st, shareholders approved an increase in the company's authorized shares, now up to 1 billion, and also passed new bylaw changes related to governance and director elections. Typically, moves like these signal a company preparing for expansion, mergers, acquisitions, or major strategic pivots. And considering BigBear's recent purchase of Ask Sage and new global partnerships, everything suggests that the company is gearing up for a much more aggressive growth phase. But everything that sounds promising has a flip side. BigBear's revenue in Q3 came in around $33 million, falling roughly 20% year over year primarily because of lower activity on certain U.S. Army programs. On the surface, the earnings looked strong because the company reported about $2.5 million in net income. But that number is misleading because it wasn't driven by the business improving. It was mainly due to changes in the valuation of derivative liabilities, which is entirely non-cash. In other words, the profit was an accounting adjustment, not the result of selling more products or delivering more services. This is important because many investors see those profits and assume the company has turned a corner. But the underlying business performance didn't change much. And that matters when you're trying to evaluate the health of the company. Now, the balance sheet does show some strength. BigBear ended the quarter with around $456 million in cash and equivalents. Their current ratio is over 3, meaning the company has triple the current assets needed to cover short-term debts. That's a comfortable liquidity cushion and gives them room to execute their plans without the immediate pressure to raise money. Management reaffirmed full-year revenue forecasts of $125 million to $140 million. But forecasts are meaningless if the foundation isn't stable, and that's why we need to look at upcoming catalysts and risks with full clarity. On the positive side, Big Bear has a 30-year history supporting U.S. military and intelligence missions. That kind of experience is extremely difficult for competitors to match. And now, they are taking that same expertise to commercial and international markets. They formed a fascinating partnership in Southeast Asia involving companies like EasyLease and Alex. Together, they plan to bring advanced AI and border security solutions to Malaysia, including support for the nation's growing space technology initiatives. Being part of an emerging aerospace corridor could open completely new revenue channels for Big Bear. In the United States, their technology is already being used for enhanced passenger screening at Nashville International Airport. This type of adoption strengthens their credibility in the civilian sector. And then comes the Ask Sage acquisition, a generative AI platform that Big Bear is buying for $250 million. Ask Sage is projected to bring around $25 million in recurring revenue next year, which could be a major growth engine if everything goes well. But again, every good catalyst comes with risks that investors absolutely cannot ignore. Outside of the latest quarter, Big Bear's revenues and bottom line results have generally been weak. Even though losses seem to be narrowing, the business is still under pressure and likely will remain that way in the near future. Here's another overlooked complication. On December 19th, Big Bear made a deal with certain investors to exchange 2026 convertible notes for newer notes maturing in 2029. These new notes include embedded derivatives, meaning the company is forced to calculate their fair value every quarter based on stock price movements. This creates earnings volatility, sometimes extreme, even when no real cash is involved. So, upcoming earnings could look unusually good or unusually bad purely because of accounting rules, not because of operational performance. And dilution is another concern. When holders of these convertible notes decide to convert to equity, Big Bear issues new shares. Over the last 3 quarters, over $57 million worth of notes have been converted into more than 16 million shares. More shares mean your ownership percentage shrinks, earnings per share fall, and stock sentiment weakens. There's also the issue of debt covenants. The convertible notes include conditions and restrictions. Breaking them or even coming close can give lenders leverage or trigger repayment clauses. Some of these clauses are tied to major events. If triggered, Big Bear could suddenly face enormous pressure on its liquidity. Another major risk is customer concentration. Only 4 customers make up more than half of Big Bear's revenue. If even one of those contracts slows, delays, or disappears, the company's financial stability could take a hard hit. And when we're talking about companies that depend heavily on government contracts, political shifts, changing budgets, and procurement delays can all play a massive role in the company's revenue timing. Now let's step back and talk about the stock itself. At the current price around $7, the stock has had a monster run, up 55% this year and 141% in a 12-month period. But analysts covering the stock are cautious. Out of 5 experts, the average rating is moderate buy, with a high-end price target of just $8. That signals only about 15% potential upside, and that's assuming everything goes smoothly. When a stock that fluctuates as aggressively as Big Bear has such a limited analyst upside, traders need to be extremely careful. It means even professionals evaluating the fundamentals are not confident enough to project a large near-term gain. So what's the final verdict? BigBear.ai sits in the category of high risk, high reward. The catalysts are strong: government-grade AI, international expansion, generative AI acquisition, commercial adoption, and a long record of experience in secure environments. But the risks are equally strong: revenue declines, customer concentration, dilution, derivative-driven earnings volatility, and dependence on government budgets. Some traders can handle a roller coaster. Many cannot. If you're someone who invests based on stable fundamentals, consistent growth, and predictable earnings, Big Bear may not be the ideal pick right now. But if you're a high-volatility investor who's willing to take calculated risks for the chance of outsized rewards, then this stock could be on your radar. What matters most is how you balance risk versus opportunity. Now I want to hear from you. Do you believe BigBear.ai still has room to grow, or do you think the stock is near its ceiling? Does the potential outweigh the risks? Drop your thoughts in the comments and let's talk about it. This is not financial advice.